You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. Welcome back to the Advisor's Option, the program here on the old Options Insider Radio Network for you, the busy financial advisor or asset manager. Maybe you've heard about these options things and you're thinking about some interesting ways that you can maybe incorporate them into your clients' portfolios, as well as, of course, for those of you out there, perhaps you're looking for a new advisor or fund manager or asset manager, and you're thinking, what sort of skills should they bring to the table? Well, we've got you covered. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. Quite a few programs for you guys to enjoy on the old network, including many, many archived episodes of this program, The Advisor's Option. So if you're just discovering us for the first time, you're saying, well, what else do you guys talk about? Well, check out the archives. You can, of course, find those pretty much anywhere you find your favorite podcast programs. The easiest place, of course, being theoptionsinsider.com. We have a lot of great written content from the world of options there, breaking news, headlines, unusual activity, education, all that fun stuff. And, of course, right there, top left corner of that page is our Insider Radio Network tab. You click on that tab, and your adventure has begun. Click on from there, the nice overlay pops up. Click on the Advisor's Option portion, and you're pretty much off to the races with all the archives ready for downloading and streaming at your fingertips, as well as, of course, all of the show notes for every episode, so you can follow along with some of the topics that we're discussing. Of course, you can also find it in all of your favorite outlets, iTunes, TuneIn, Stitcher, etc. We're working on Google Play, so as soon as they go live with that, this program will be available there as well. I believe it's still in the testing phase, so not open to the public yet, but as soon as that goes live, you'll be able to have it there. And, of course, via our mobile app available for iOS, Android, and indeed the Fire OS. And, of course, we are adding more live programs to the network these days. Kicked off our big 500th episode spectacular, the Option Block, last week with a live broadcast, and it was pretty fun. So we're looking to add that to more episodes and more programs as well. So look for more live content from us coming down the pike sometime soon in the near future. So a lot of fun stuff. Then check it out wherever you find your favorite podcast programs. And, of course, while you're listening, while you're downloading, while you're streaming, We'd love to hear from you guys. Send us your questions, your comments. Of course, you guys are the reason we do this program. And joining me on the old program today is my advisor's option compatriot, Randy Swan, the co-founder of Swan Global Investments. Randy, welcome back to the Advisor's Option program. And where are you beaming in from today? Scenic and tropical Puerto Rico or back over there in the old mothership of Colorado?
Today I'm in from Puerto Rico, where it's almost always 80 degrees. I was in Colorado last week skiing and visiting the team back in Colorado. And I came back and I realized it really is hot and humid here.
Yeah, I'd imagine that's a little bit of a culture shock coming from skiing in Colorado, getting back to the relatively more tropical and humid region of Puerto Rico. But I'm guessing not an unwelcome one, since you did move down there after all.
Exactly right.
All right, and we have a great guest joining us today in our The Buzz segment. So without further ado, let's get right to it and check out The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, that music means it's time for us to do a little bit of the heavy lifting for you guys out there. You guys, the asset managers, the advisors, you're pretty busy. You're busy managing your portfolios and dealing with your clients. You don't always have time to keep up with the latest research and developments and news coming out of the world of financial advisors, certainly as it pertains to options. So we do it for you here on the old program with a little segment we like to call The Buzz. And joining us for this segment here, we have yet another compatriot from our friends over there at Swan Global Investments. This time it is Chris Hausman, the senior trader and chief market technician over there at Swan. Chris, welcome to the Advisor's Option program.
Thank you very much, Mark.
And Chris, as we are wont to do with all of our first-timers here on the old network, why don't you go ahead and give us a little bit of an overview of your background in the options and derivatives world, as well as what it is you actually do over there at Swan.
Sure, no problem. So my experience actually started the summer before my senior year in college. I was fortunate enough to be in Chicago and got a clerking job at the Chicago Board Options Exchange. I clerked in the OEX pit, which was the S&P 100, and at that time it was the largest and most active pit at the time. So after that summer, I finished up college, went into investment banking as an analyst, and never forgot my days on the pit. I picked it up rather quickly, had a lot of good times down there, and I loved Chicago, and I decided, well, investment banking's not for me. I'm going to do everything I need to do to get back into the trading world. So fortunately for me, I was introduced to the International Trading Institute in Chicago, which was a school founded by Anthony Saliba. And if you've read the first Market Wizards book from Jack Schwager, he was the only options trader featured in that Market Wizards book. So I got my education through there. Upon finishing my training, if you will, I started with a multi-index, multinational arbitrage firm, Wolverine Trading. So I began trading at the Chicago Mercantile Exchange. I traded options on the S&P 500 future, and I did that for a few years. Got a phone call from Anthony Saliba telling me he was going to start a new trading firm upstairs, needed someone to help him build a desk. And really, he told me, we were going to be upstairs market makers and liquidity providers. So I didn't really know it at the time, but what we were doing was laying out the current model of the new upstairs market maker / I guess we call them liquidity providers now. Because if you've been to the Chicago Board Options Exchange lately, there's only a couple of pits open. It's all open space now. So I was very fortunate to get that kind of education. I got two very good schools of thought from the Saliba world and the Wolverine world. And now I'm here at Swan, acting as overseer of the trading desk, risk management, and during that time I was able to get my chartered market technician and kind of specialize myself in technical analysis. I had all this options background, but when I made the transition from floor market maker to upstairs trader, I just needed something else to kind of fill in the hole, and I felt technical analysis has been doing that for me lately.
So you come from the old school then, the OEX. I like that. Not a lot of guys who have OEX experience. By the time I got into the SPX, it was already clear the writing was on the wall for the OEX at the time. So there wasn't a lot going on in the OEX pit, and that soon ended up all of it pretty much transitioned into the SPX. So yeah, interesting stuff.
Yeah, exactly.
That was the pit du jour for a long time over there at the old CBOE, and then it transitioned to the SPX, which is still kind of like you said, one of the last game in town over there. That and VIX and a few others when it comes to actual pit traded products out there. And of course, we're very familiar with Tony and his various initiatives over there. He's been on a number of times in the past, and hopefully get him on again one of these days. He's always fun to check in with what's cooking in the land of all things Tony these days. But we're not checking in on that today. We're checking in on some interesting stuff. We always bring on a wider range of guests and different content and studies, and we have a lot to talk about on this show as well. But we thought you guys are always cranking out some interesting content over there in the land of Swan and some of your own research. And we featured some of that in the last episode. We're going to do so again today. And as you mentioned there, Chris, you do have your CMT there, which is kind of useful for the type of work you're doing over there now. And you put out an interesting piece over there on Swan that kind of caught my eye. It was called "Do Market Anomalies Occur More Frequently Now?" And as you mentioned, this is kind of a bit of an aggregation of of course, the options side, but also some of the statistical movements and technical developments we see out there in the marketplace, breaking down some of the the more extreme, the multi-sigma moves we're seeing out there in the marketplace, as well as their kind of frequency of occurrence, and some of the other interesting issues that evolve in the marketplace is certainly within the recent decade and the big significant structural changes we've seen out there in the marketplace, not just the fragmentation, but of course things like the uptick rule and things like that, and of course how that plays back into utilizing options in the space. I just gave our listeners a bit of a 10,000-foot overview, but you're the author of this paper, so why don't you go ahead and walk our listeners through exactly what you were looking at with this paper and what some of your interesting findings were.
Yeah, sure. So let me start off with a little bit of history here, if you don't mind. So the French mathematician Bachelet back in 1900 said stock returns follow a random walk, or in other words, a Brownian motion. And we're all very familiar with random walk. So another mathematician after that, Mandelbrot, came along in 1963, and he rejected that hypothesis and suggested that returns were leptokurtic. And everyone's familiar from their Stat 101 days about the normal distribution, et cetera, et cetera. So what leptokurtic really means is that a lot of the observations are going to be clustered around the center. So unlike a normal distribution where you're plus or minus one standard deviation, you'll have 68% of the observations in that observation, or in that range, if you will. So the leptokurtic distribution has a much higher percentage of observations in the center, but then as a result, you're going to have these very large tails. So leptokurtic in the marketplace since 1950, we've been noticing about 95% of the daily observations plus or minus one standard deviation, or one sigma is just another word for standard deviation. However, what we've been noticing though is that there's more occurrences of these larger sigma moves, characteristically known as 3 standard deviation events plus, or even 5 standard deviation events. The really outliers that cause a lot of damage to the financial system in the short term. So, we're always going to have this endless battle between efficient market hypothesis and behavioral finance. And one thing we can all agree on is that the markets have become more volatile over time, and especially since 2000. You can watch the financial press on any given day, and you're going to hear some new record-breaking stat. So it's happening more and more and more. And this is what got me thinking, why every day when I'm watching, XYZ TV show, why am I being told this is the third occurrence of this? This has happened since, X date. So, and recently we just had the SPX just had 3 1% up days in a row, and that hasn't happened since 2011. It was the best quarter for gold in 30 years. So we're getting bombarded with these stats over and over again. So it just got me thinking, why is this happening? And, our research team, and we decided to do a little bit of digging into the data and the stats and kind of see, well, what's going on in the marketplace, especially as of late, that maybe things are kind of changing a little bit. Maybe the limitations of using a normal distribution, which is we all grew up on that, is not, that is not the best way to manage your finances. Just to some more evidence of multi-sigma events, October 13th, 2008 had a 12 sigma event up day. The Black Crash, October 19th, 1987 was a 21 sigma down day. So at the end of the day, standard deviation has become, using plain standard deviation has become an inadequate and poor measurement of total risk. And the problem is assuming normal distributions can be found in a lot of models that we use today, like modern portfolio theory, capital asset pricing model, value at risk uses it, and even Black-Scholes uses it. So we have to be very careful about, assuming normal distributions and just using standard, your basic standard deviation calculations for portfolio management. because models will break down. They're going to break down with extreme moves, and they severely they underestimate the actual risk that you have. So, 5 sigma events, and just to put some numbers behind this, that occurrence is supposed to happen 1 in every 3.5 million observations. So when you start talking about 10 sigma events, you're talking about a pretty big number, and a lot of financial software packages don't even have enough zeros at the end to really give you the idea of how large this number is. So, and the reason I mentioned the 10 sigma event is because that's what blew out long-term capital management. They went through the 97 Asian financial crisis, the 98 Russian financial crisis, and I was actually down in the pits at that time. So it was a crazy time, and I remember it vividly because I just gotten my badge, and I was still considered a rookie trader at the time. But it was a really good learning experience, and taught me the firsthand what tail events were, if you will. So even in 2007, there was a CFO of a major investment bank that said, during the mortgage crisis, that they were witnessing 25 sigma events. And I recently read a study that a 25 sigma event is the equivalent of winning the United Kingdom National Lottery like 21 or 22 days in a row. So these are some pretty big anomalies, pretty big fat tails that are occurring in the financial markets, a lot more than, again, what a normal distribution or what you would learn in your Stat 101 course would teach you. So, moving forward for the options world as well, what do we do about these things? First, we can't predict them. So that means we need to be always prepared, which means we need to, if we have a long portfolio, we need to be always hedged. I mean, that's the number one thing. But obviously, that may not be the entire answer, because of these events. So, is hedging with puts or put spreads the answer? Sometimes it's not, because it could be prohibitive. They may be costly because of increases in volatility, et cetera. So there are other strategies, multi-leg strategies that may give you better bang for your buck, if you will. Some of them could be butterflies or condors, but mostly when people trade butterflies and condors, they're doing at the money type stuff. So what we like to do, and what I try to scan, are just for these small butterflies that are way out on the wings. Very cheap, something that we can help enhance the portfolio, if you will, add a little bit of protection for a small amount of cost, et cetera. So it was something that I picked up over the years, from other people that I've learned with, is just constantly looking at butterflies and bouncing them around, if you will, to help kind of protect these wings, protect the portfolio just a little bit more and help reduce the standard deviation, if you will.
So that's interesting. So you're going beyond your typical approach of the DRS there to actually add some additional, call them hedges, call them kickers, call them what you will there, but essentially far out of the money butterflies as a way to try to interesting profit on this. I know a lot of people are listening are probably going to say to us when they listen to this, they're going to say, well, what does this mean? Of course, for you hear this bandied about in the media. I even hesitate to bring it up because it's so overused, but the notion of these black swan quote unquote events, these multiple 6 sigma plus events, it sounds like there's a lot of debate in the world of options whether these things are overpriced into things like S&P puts, or whether they're underpriced. It sounds like you're saying kind of a little bit of both. It sounds like you're saying that the puts are obviously expensive, maybe too expensive sometimes for a lot of the day-to-day use, but if you're getting some of these other types of events, you could probably price in some of these farther beyond butterflies and use that as an interesting approach, as a way to maybe augment some of your exposure to these very extreme events, these 6 sigma and beyond events.
Yeah, absolutely. That's exactly what we're saying.
And you speculate on some causes for this in your paper. A couple of them you bring to mind that are kind of interesting. Of course, the uptick rule and the changing of that around 2007, and they subsequently dialed that back a little bit. I believe that was in 2010 or so. But effectively, it used to be you only could short sell when, of course, so there was an uptick in the underlying. They got away from that, and then they kind of semi-implemented it again, but more along the lines of only kicks in after a significant sell-off in the marketplace. Some people speculate that was the case. Of course, there's extreme fragmentation on the equity side, and we're seeing more of it in the world of options as well. In fact, just this past week, we got our 14th listed U.S. options exchange. So if you're paying attention out there, listeners, that's pretty much 14 exchanges, all pretty much trading the same thing. Your Apples, your Facebook, your Googles, your GLDs, a few like CBOE trading a few extra like SPX and VIX, and the aforementioned much missed OEX. But aside from that, it's really kind of everyone trading the same stuff. So is it those two things? Are there other factors? What do you think is really driving this increased volatility out there?
Well, there's going to be a lot of different factors. You just harped on a couple of the main ones, and you can probably add additional color. But I know I was told once upon a time that the majority of the volume on the New York Stock Exchange emanated from market makers over the Chicago Board Options Exchange. I haven't validated that or anyway, but if that's the case, today 65 to 70% of the volume on the New York Stock Exchange now is from high frequency trading. So the elimination of the uptick rule, I mean, I'll be honest with you, I never even heard of high frequency trading before 2007. And all of a sudden, I think we hear about it every single day now. So I think the elimination of the uptick rule really allowed them to come into the market space, which is, if you're familiar with high frequency trading, a bunch of computers and algorithms running the show, as opposed to back in the day when there were human beings buying and selling stocks. So I think some of the added volatility is directly correlated because of the elimination of the uptick rule, allowing for the high frequency trading world to step in and do their thing. The fragmentation of the markets. It used to be IBM only traded at the CBOE, Microsoft only traded at the P-Coast. So now, like you mentioned, it's everywhere, and they're trading the same thing. I mean, there have been some added benefits, reduced brokerage fees, costs for clients, but what is the true cost here? I mean, are we really willing to live with the volatility that we have today? Is it going to continue to increase? I mean, what kind of path are we going down with more exchanges and very little regulation on the high frequency front, et cetera? So it's something that we like. It all ties in with the multi-sigma event because they're happening more and more, and we can't ignore it. So, but also in the paper, I mentioned that it's also going to be extremely hard to market time. If you miss the 10 biggest up days, your portfolio is going to be destroyed. So market timing is one of the most difficult things out there, and the best way is to have a sound approach that's lasted over the years, that has taken the punches, if you will, but continues to stand up and is going to be there again tomorrow.
Yeah, you kind of, that's the rub end of the day, right? Because if you're trying to market time, then you're probably going to miss at least a handful, if not more, of those big moves you want to capture. Then, of course, you're going to be getting those angry calls from your clients about, hey, why did we miss all of these big moves that make your year? So, yeah, it's a bit of a challenge. And, of course, if you stay in the market, you're subject to all of these multi-sigma events. So how do you stay in while still keeping your head above water? And that's kind of why that's the whole reason behind this show is using options for that particular use case. And, speaking of use cases, you do focus the paper a little bit around ETFs, and it's kind of really structured around ETF holders and structuring portfolios of ETFs. Was there anything in particular about ETFs that made you really draw your eye to this segment of the market? And are they perhaps even more prone to these multiple events? We've seen a lot of issues lately with just the calculations of these ETFs in the wake of these other big underlying shocks. Let's say the August 24th massive sell-off. A lot of these ETFs were just simply broken for a period of time because they're kind of calculating off these other assets. So that makes it challenging. Is there something unique to the ETF world, or was it somewhere that's kind of where you just started your analysis and it kind of just snowballed from there?
Well, the ETF world is growing leaps and bounds. I mean, the volume continues to grow there. It's also a good area, for people that don't want to trade individual equities, an Apple and IBM, if you will. So, but like you mentioned, there was some dislocation August 24th between the individual components of the ETFs and the actual ETF compilation. So, that's a product that, maybe you have to even be more cognizant of the tails because maybe they are broken, but, it'll get figured out, and it's more. I reference the ETFs just because of the volume and the opportunity for clients to look at those products as opposed to individual equities on companies.
Yeah, one of the major structural changes in the marketplace, in addition to the things we just mentioned and the regulatory environment, you're right, I don't think anyone could have foreseen a decade or two ago just the rise of prominence of ETFs and what a substantial percentage of ADV they would represent here now in 2016 and probably just growing going forward. So you're right. Any sort of analysis that doesn't look at ETFs certainly perhaps is missing a key portion of the marketplace and indeed of the analysis. Randy, what are your thoughts here on this paper and indeed some of the takeaways it may have for our listeners out there who are scratching their heads over the perhaps terrifying paper and some of its interesting conclusions?
Well, first of all, I like what Chris has written. At Swan, we're always trying to solve the problems out there that exist in the market, and I think his paper does a good job of explaining that the increase in those events are occurring. And as it relates to our strategy individually, I mean, we're just out there trying to eliminate as much of that risk as possible. So from our perspective, the real question is, if you acknowledge that these events are occurring more frequently, what is the best way to solve that problem? And of course, our kind of corporate philosophy is not necessarily market timing or stock selection, and that's why we use the ETFs as well as the hedged products, using derivatives options to really manage most of the market risk. So from that perspective, we're pretty confident that our strategy will actually be able to roll with the punches, I guess, as it were.
All right, listeners, if you want to check it out for yourself, it's over there on the Swan Global Investment site, or just search for the paper titled "Do Market Anomalies Occur More Frequently Now?" And I think it's a lot of interesting charts and things we couldn't get into here on the show. Obviously, I encourage you to check it out for yourself, getting into some of the different distribution elements of the marketplace and certainly how that can impact a lot of your clients going forward. And Chris, I'm glad you could join us. And actually, if you're up for it, we have a few more interesting discussion topics to hit on in the buzz. So if you're up for it, you can join us for these other topics as well. Kicking off with one of my favorite, and I put favorite in quotes, is in the realm of annuities. This has always been a big topic for advisors in the asset manager space in particular. I've always kind of jokingly referred to them somewhat as a poor man's option, because a lot of advisors, I know when I've talked to them, you guys have probably encountered this as well in asset managers, when you talk to them about why don't you use options for income and things like that. So one of their frequent pushbacks is, oh, well, I just use annuities with my clients, and we put them in those instead, and they supposedly deliver these type of results, and of course the advisors and asset managers get a hefty fee on those as well. And I've never liked that approach for a variety of reasons. It kind of shoves a lot of clients into an approach that probably maybe not in a product that may not be suited for them. B, a lot of these annuities are very poorly constructed, which is a huge challenge. The fees are enormous. And also a lot of these people who push back against the notion of using options and derivatives in these portfolios, guess how a lot of these annuities generate those returns? They use these products themselves, and usually not in the best way. So it's kind of a stealth derivatives exposure. A lot of people don't even realize they have. And so I've always thought, if you're going to do that, if you're going to go that way, you're much better off. And certainly the client is much better off actually constructing it yourself, using options products and actually going through the proactive steps of writing the calls and generating the income, et cetera, and constructing their portfolio. I know a lot of advisors don't want to do it. They want to take the set it and forget it approach. But still, that's one of the reasons we do this show, to try to educate you guys on some other ways you can do it and hopefully generate much better returns for your clients as a result. And that, of course, at the end of the day, is what everyone is after. And now, of course, annuities have been out there for a long time, variable annuities and others. And we, of course, talked recently on this program, was a huge issue with the Department of Labor's fiduciary exemption, their proposal to try effectively ban options in IRAs. It seems like some of that language is being mitigated now, which is interesting. But some other components of these changes the Department of Labor is proposing have some other, perhaps more welcome side effects when it comes to options and the financial markets, and of course the use of annuities within. Essentially, one of the other things they've added with this proposal is to effectively apply what they're calling a fiduciary standard to financial advisors. And you guys, all of our listeners, know what that means, but essentially in a nutshell, they effectively have to work in the best interest of their clients at all times. And that could sometimes, and also avoid conflicts of interest, which could sometimes be seen in a lot of these prepackaged annuity type products where the advisor really has a vested interest. He's really becoming a salesman at that point. He's not really being a financial advisor. And he gets the commissions, all these other incentives that could probably be dubious for a lot of the clients. Well, going forward, looks like this fiduciary fiduciary proposal from the Department of Labor is probably going to squeeze out a lot of that approach. It's going to make it very difficult for a lot of these advisors who are being held to this fiduciary standard to go the old low-hanging fruit route of just recommending an annuity and kind of washing your hands of it and just collecting your commissions on an ongoing basis. Of course, it's a huge business. Last year, about $100 billion or close to it just in the first 3 quarters of 2015, just in the variable annuity side. So it's a big business when it comes to the advisor space. And this proposal is probably going to shake a lot of that business out. But, for a program like this and for advisors who are so motivated and inclined to tune into a program to want to learn about options, I think this is actually very good news. Because if you've been using some of these techniques and these approaches we've been talking about on this show from episode 1, things as basic as, hedging with protective puts to getting into collars and writing covered calls for income, and then put spreads versus puts, and selling puts as a way to get in long and getting income that way, and wheel trades, etc. There are a lot of ways you can utilize these techniques to replicate these approaches on behalf of your clients in a much more effective way going forward. So personally, Randy and Chris, I'm actually kind of excited about this proposal. I'm sure you guys probably are as well, because you probably heard a lot of pushback in the space as well. Why should I bother doing these intricate overlays when I could just put on some of these other, much less functional structured products and just go with them instead? So I'd imagine this proposal, if it goes forth as it stays right now, and it seems like it's going to really hit the variable annuity space and probably, hopefully, drag the modern advisor space into the 21st century. So Randy, maybe we'll start with you. I'm assuming this is probably welcome news for you guys, because it probably will, A, like I said, wake up a lot of the advisor audience, and B, probably make them more receptive to the discussion of how can we now take this approach and replicate it ourselves using some of these other type approaches out there, which, of course, leads them right to what you guys are doing over there at Swan.
Absolutely. Well, I always start off the basic premise of competition is good, and anything that you can do to drive competition is good for the consumer at the end of the day. We've had other conversations about the government getting involved and, trying to kind of muck things up and cause more problems, and it's good. But I think this is a good example of bringing down fees and making people be a little more honest to get their clients into products that I think are better. And of course, as it relates to what our strategy does, or people like Swan do relative to some of these other variable annuities, I think obviously we do provide something that's definitely different and most likely better and cheaper. So absolutely, I think this is a good move. Good move in the industry, just like I think everything else, like the advent of ETFs have been really good, I think, for the mutual fund industry in terms of driving down costs on things like that. You really, at the end of the day, it comes down to you providing value add to the client, so it ends up being a win situation for the client.
Yeah, it's kind of been our argument from day one, and certainly in the wake of these other threats to the advisor space, like the robo-advisors, it seems like the push is always to provide more value to the client just to keep the business and provide more value added as an advisor and asset manager. This is just yet another example of that. You're being forced to do it now. I'm curious to see what some of the questions are as a result of this, as a lot of advisors maybe who've been over-reliant, shall we say, on this annuity business and now are kind of forced to perhaps take a different approach. It'll be kind of interesting. All right, good stuff there. We got to keep on rolling with the Buzz segment, though. If you want more information, keep an eye on, of course, that the Department of Labor proposal. It's kind of interesting. Department of Labor takes with one hand with the IRAs and options, and the other hand they give back with removing some of the annuities things. So we'll see how all that shakes out in the wash in the coming months. Hopefully, even by the next episode, we'll have more insight into that. If you have questions about that, you're an advisor out there and you've used annuities in the past, maybe you want to learn more about how options can be an effective alternative, probably more effective, write in. Let us know. We'd love to hear from you guys. Maybe you have some specific questions we can help you guys with as you're building your practice or perhaps evolving it here in the modern era. And Chris, I think you like this next story. It's kind of right up your alley. We were talking and started off the Buzz segment talking about some interesting data and the aggressive, shall we say, multi-sigma moves we're seeing out of the marketplace. One of the things we like to do on this show, of course, is always arm you guys, the listeners, with a lot more data that you can use when talking with clients and investors about options and how effective they may be as a tool going forward. Well, that's why we usually have the OIC guys on. They always bring great data to the table. We talked about a study coming out of the CBOE a few episodes back about using weekly put rights. Well, now they have more updates. The CBOE is just cranking out a lot of interesting studies these days. Interestingly enough, the last one was on the S&P. This moves it into another area that a lot of advisors and asset managers may not be as familiar with. This is on the Russell. So, of course, the small cap kind of stuff. An interesting area, certainly an area that should be attractive from a volatility perspective, because because just inherently small caps should be a little bit more structurally volatile than the large cap stuff. So if you're looking for that, then this might be an area that intrigues you. And they broke it down over they have about 6 here. They're probably lesser known indexes they disseminate on some of these Russell products, in particular the Russell 2000 Buy Right Index. That's similar to, of course, their Buy Right Index on the S&P, just writing at the money calls. Their Zero Cost Put Spread Collar Index on the Russell 2000, kind of, I think that name says it all. Their Conditional Buy Right Index, where I think they believe they adjust the strike a little bit. A 30 Delta Buy Right Index on the Russell 2000, and the Put Right Index, which is essentially just writing at the money puts every month. And then an update to that, which is the weekly, 1 week Put Right Index, kind of comparing and contrasting the weeklies. We found on a recent episode that writing the weeklies in the S&P was demonstrably more effective than doing it on a monthly basis. And now some interesting data coming out of the Russell side as well. They compared this study, I think it goes back to 2001, so the last 15 years, from 2001 till now. They're saying that this Put Right Index has compared to just owning the Russell outright. So if you just went out and just bought the Russell 2000 for the last 15 years versus writing these monthly puts. And it's surprising to a lot of people because they still think of put writing as being just inherently extremely risky, and certainly if it's done poorly, it can be risk additive. But done here, the way they compared it, they found that writing these monthly puts at the money puts had higher overall returns than just owning the Russell outright, which at the end of the day is what everyone's after, lower vol, and higher Sharpe ratio, so risk-adjusted returns were also better. So kind of delivered everything you're looking at doing versus both the Russell 2000 and even a Citigroup 30-year Treasury bond index. So no matter what you're kind of comparing it to, the underlying or even a safer fixed income underlying, it performed extremely well. Also, the put rights, all these indexes we talked about, BXR, CLLR, and BXRD, all had lower annualized standard deviation. Gets back to some of our earlier conversation about the standard deviation in the marketplace, ranging anywhere from about 14 to about 20% lower than the Russell itself. So again, getting back to that risk-adjusted basis, not just total returns, but risk-adjusted, these strategies performed very well. Also, it kind of captured what we talked about here, the volatility space. In general, that term for that is the risk premium, the level of implied volatility, what the market is pricing in versus the actual level of volatility the market is exhibiting. Implied is always going to be higher for a variety of reasons. Of course, you're guessing what future volatility is going to hold. So as a result, you're always going to have a little bit of a fudge factor built in. That fudge factor is known as the risk premium in the marketplace. And it's pretty rich out there in the Russell products. This is since 2004. They found that Russell 2000 products the risk premium has averaged nearly three vol points, about 2.88 vol points. So the implied volatility, about nearly 3 volatility points higher than the actual volatility, the realized volatility exhibited in the underlying. Again, that's an attractive thing from an overall premium selling, premium harvesting type approach. So if you're into even covered calls or short puts for income or any type of premium selling strategies, the Russell may be an attractive alternative. And also an interesting kicker, this kind of dovetails on what we talked about in the last episode, comparing writing weekly contracts versus monthly contracts. The standard way a lot of these things have been designed is to write a 1 month put or a 1 month call and then do it again every month. Well, now we have weeklies out there and they're extremely popular. So the next question is, what happens if you change that to the weeklies? And we've talked before on the show about trying to maximize when you're writing options, your exposure to that essentially exponential portion of the time decay, the theta curve there, which occurs usually in the final few weeks of a monthly options lifespan, or in the case of a weekly, it's kind of all theta all the time. So in theory, even though you're collecting less every time you write an option, if you do it 52 times versus 12, you might stand to make a little more in the long run. That's exactly what this study found as well. They found the aggregate gross monthly premium as a percentage of the actual underlying was extremely high, 41.4% for the weekly put right versus 22% for the monthly put right. So nearly 2x the type of return in terms of aggregate premium collected, which is interesting. Of course, you have to look at how the underlying performed, and there's other things that go into that as well. But just from an aggregate premium perspective, that's an extremely interesting number. So again, a lot of data that you can arm yourself with when you're looking at these types of approaches, or you're looking just to consider options and discussing them with your clients. Chris, we'll start with you. I know you recently focused on the ETF space and kind of the data coming out of that. There is some more data on probably maybe an area you haven't thought about in a little while, the Russell 2000, and also kind of backing up a lot of the things that we've talked about on the show in the past, to the fact that a lot of these options-oriented approaches are competitive, if not outperforming from an overall return perspective, and certainly blow the doors off from a risk-adjusted return perspective. So some interesting data here, particularly on the weekly side as well, incorporating the weeklies. What are your thoughts on this data? And who knows, does it inspire you to maybe to think of some other approaches for papers down the road over there at Swan?
Yeah, first of all, the CBOE has always been very innovative about all the products, and I'm a big believer of anything that's going to lower volatility and increase your risk-adjusted returns is going to help out the overall customer base. We did similar studies on the SPX way back when, and it's good to see that they're now applying this to other index products. So I'm quite sure the CBOE is going to keep doing this on just about every product they can. So again, it's just offering more choices for people out there, because maybe the SPX isn't the answer for somebody. Maybe the NDX isn't the answer. So it's a good thing that they are focusing now on the small caps and going to the Russell. So yeah, it's something that myself and our research team, we are always turning rocks over and trying to figure out, where can we squeeze, the next bit of performance and reduce overall standard deviation, because that's what our clients want. That's what our clients demand, and that's our job to try to figure out what the next best product is.
Well, Randy, I know we featured a lot of study authors on this show in the past. We'll probably have a lot more in the future. We're big fans of data and the hard numbers here that you can use to back up some of these options theories. So I'd imagine you echo Chris's sentiments there that, the more data, the merrier when it comes to the efficacy of these option strategies, regardless of what the underlying is, S&P, Russell. That's kind of almost immaterial to the basic fact of the efficacy of these strategies at the end of the day. So I'm sure you're probably also a fan of this more data, and it looks like the CBOE is going to be cranking out a lot more in the near future.
Absolutely. I mean, fundamentally, all these studies that have come out, whether it's from the OIC or the CBOE, they all point to the same direction, that using options to hedge and generate income, provide value to a portfolio along those lines, and kind of consistent with our corporate kind of mission going forward. As we launched, as I think I've mentioned in the last 2 or 3 shows, we launched a small cap version of our defined risk strategy that I think we launched it December 29th. Of last year. So we were really excited about offering different underlying assets, but under the same basic strategy that we're offering right now. So this is all good stuff.
Speaking of good stuff, it's time for you guys to get your good stuff featured on the show as we roll right on into our office hours segment.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, like the man said, this is the portion of the show where you guys get your thoughts aired and your questions answered here on the old program. I feel bad. We have a ton of questions backlogged, but we kind of went deep into the data hole here earlier on the show. But that's always fun stuff to talk about in this program as well. We'll see how many of your questions we could squeeze in. Don't worry, read them all, listeners, even if you don't get a chance to answer all of them on the show. Who knows, maybe we'll do another big office hours palooza coming up on a future episode to answer more of these questions. Let's kick things off here with Patrick D. He writes, what is your opinion of volatility ETFs such as VXX? Does it make sense to include them in a diversified client portfolio, perhaps 3% to 5%? This is a common refrain, particularly now in the space where we're seeing a lot more exhibited volatility in the marketplace. Everyone's writing in about VIX levels and things like that. So it's a natural question to say, how should I include volatility exposure in my portfolio? And people have all different ways of doing it, whether it's using a VIX product like that's that, or maybe one of these ETFs like VXX. VXX, of course, trying to provide that exposure to volatility. There's some challenges to these products as well, as we've talked about many times. not so much on this program, but a lot of other programs on our network. A product like VXX is very much disenfranchised by essentially what is known as the term structure of these futures, with longer-term volatility being very rich and expensive, shorter-term volatility not so much. These products are rebalanced on a very frequent short-term basis, so they're effectively buying a lot of long-term expensive assets and selling a lot of short-term near cheap assets, and so you can see you're losing money there. That's essentially called the yield risk or the roll risk, and over time that could be extreme, particularly in a product like VXX. I've seen some studies. It ranges depending on how the futures are setting up, but somewhere between 4 to 15% a month you could lose in this product just from that negative impact of that roll yield. So it's, I don't know, VXX maybe not my favorite one to choose from, but I think maybe even more than that, the concept of exposure to volatility. We have addressed that on this program as well. I'd encourage you to check out our archives where we get into VIX and volatility and all those things. In general, this is kind of boils down to the notion, Chris, of the old S&P put for the more direct hedge versus something like volatility, a volatility product, whether it's a VIX future, a VIX option, in this case VXX, one of these other volatility ETPs, and how these things perform. I've always been a fan myself, Chris. Maybe you have a different viewpoint, but I've always been a fan myself of the more direct portfolio hedge of, let's say, an S&P put or a put spread, because that offers you a direct inverse correlation, and of course you know exactly what you're getting with that, and you also get a volatility component. People forget that too. There is volatility, like we just talked about with the Russell study, in options. So if you're buying these options, you're getting volatility in your portfolio as well as a direct correlation, inverse as it may be, to the underlying. Versus volatility, it's kind of a mixed bag. You don't know what you're going to get, what the VIX is going to do on any given day, what these ETFs are going to do on any given day. They may not be the one-to-one hedge that people may be looking for. That said, we always welcome diverse opinions on here. Chris, you're our guest. You get pride of place. What do you have to say for our friend Patrick D, who wants to know about your thoughts on vol ETFs like VXX and whether it makes sense to include them in a portfolio, or maybe you favor more of the kind of direct S&P approach? What are your thoughts on that?
Well, Mark, I'm kind of in your same camp here. What I tell someone when I'm teaching and they're about to trade a new product is to understand all the nuances. And unfortunately, these VIX products have a tremendous amount of nuances. The number one thing is they believe they're trading the VIX, the direct product, like you mentioned. VXX is not off the direct product. It's off the front the front two futures. So you're going to have to deal with the drag, which is going to be your contango loss, as you mentioned again. And also the correlation, the movement of the VXX is only about 55% of the VIX index. And that's another big thing. I mean, people are just constantly watching the VIX. Well, the VIX was up 1. Well, my option should have done this. My call spread should have done this. And then they come to realize, well, VXX didn't move as much. It's not the exact same product. So there are certainly some challenges in here. Again, going back to, when we were talking about the Russell, the more products, the better. If it's going to help you improve your returns and reduce your volatility, that's great. But you have to do some studying. You have to do your homework, especially in these volatility products. But at the end of the day, I'm in the same camp as you are, Mark. I don't think they provide the direct exposure to volatility that people think they're getting. So they're going to have challenges trading this. Just like I said, do your homework before you do these kind of things. But VIX doesn't go up every time the market goes down, and vice versa. And people need to understand what the correlation is between these products and what the expected move in these products could be given a move in the market. And when someone tells me, hey, I think volatility is going up, the first question out of my mouth is, why do you think the market's going down? And if they don't have an answer, then I'm like, well, you're not a volatility trader, because you're going to have to do some type of studying of market movement. Because again, call me old school, volatility for me is an input into a model. It's not an output. And when you treat it as an output, you're going to have these nuances. It's going to do some things that you didn't think it was going to do. But when I use volatility as an input into my model, my option price does exactly what I think it's going to do every single time.
Well said. Yeah, and I can certainly feel for a lot of our listeners out there it sounds good on the surface to have a product that can replicate all this for you. You just buy it, stick it in a securities account, you got your exposure, set it and forget it. Unfortunately, it doesn't work that way in the long term for a lot of reasons, and we can get into those on future shows. But still, interesting stuff. Good question, Patrick D. Sounds like we're all pretty much in agreement here. VXX perhaps not the preferable path for you to go, but good question. We'd like to hear from you guys. Unfortunately, that's all the time we have for the office hours this episode. It's also all the time we have for this episode of The Advisor's Option. But before we go, let me check back in with each of my cohorts here. on the program. Chris, you're our guest, so you get pride of place. Really quick, what are some other papers people can look forward to from you and the research team over there at Swan coming down the pike?
Well, we're definitely going to continue looking at volatility. I mean, we're going to discuss the anomalies probably a little bit further. But again, the more studying we do, the answer always comes back to what we're doing here at Swan. And that's always hedged, always have your protection, and we're not going to try to time the market here. It's just, like I said, you miss the top 10 days, you pretty much devastated your portfolio. So you can be assured that, the products that we have are hedged always, not involved in market timing, and we're here for the long run. I mean, we've been here for 18 years. So, we talked about since 2000 in the piece that anomalies are increasing slightly. Well, we've been around longer than those anomalies have been, and we're going to be here longer. So, and that's because of the basic core foundation that we've had here, and then what Randy and Rob Swan started 18 years ago.
And Randy, you mentioned, of course, the launch on the small cap stuff back in December. What else is coming down the pike over there at Swan? And of course, a little birdie told me you may have an interesting event coming up. Why don't you also give our listeners a little bit about insight into your upcoming conference there in Puerto Rico?
Absolutely. In addition to the two funds that we launched in late December of last year, we are having our first initial Swan CAO Investment Summit. It's going to actually be in San Juan, Puerto Rico this year, since Swan has moved down here about 2 years ago, almost next month. So we're pretty excited about that. We've got some great sponsors. Anyone interested in some information on that, go to our website. We are planning on recording most of the event, so that those people that are not able to go probably will be able to get access to a lot of the content and a lot of the discussions and stuff like that we expect on having. But given this is our first event, we're pretty excited about it, and we think it's going to be a successful turnout.
Yeah, I'm looking forward to it. I should be down there as well, so we'll hopefully put together some great content from the show, maybe some advisors options episodes and some interviews, as well as, of course, like Randy mentioned, all of the panel sessions down there. I'm looking forward to it myself. Check it out. Surf on over to swanglobalinvestments.com to learn more about the event, as well as all the papers Chris was talking about, as well as all the updates to the products that Randy mentioned. And unfortunately, they couldn't join us. They're gallivanting around the globe right now, but our friends over there at OIC have a lot of great content as well. Surf on over to optionseducation.org. Top right corner of the page, you'll see the resources for advisors section. Click on that tab and your journey has begun. All this great data we're talking about here on this show, they have a ton of it over there that you can dig into. Collars, the efficacy of collars across a variety of underlyings, things like covered strangles, all kinds of interesting stuff they have over there. So if you're looking to arm yourself with some data that you can talk about with your clients, then OIC is the place to go. Optionseducation.org to learn more. And on behalf of Chris and Randy, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show, and of course, for sending in such great questions. Keep them coming. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.